Hello. Today we're going to review the sensitivity analysis and how it can be used as a tool for capital budgeting. We will first cover how to incorporate risk in capital budgeting. Next, we'll cover what is a sensitivity analysis. Third, what are the qualitative steps, followed by what are the quantitative steps, and then we'll finish off with an example. So why should we incorporate risk into capital budgeting? First, capital budgeting includes many variables. Many variables come with uncertainties. Uncertainties equal risk, and risk can lead to unnecessary losses. Sensitivity analysis can provide insight into those risks and make them a little bit more predictable. So what is a sensitivity analysis? It is also referred to as a what-if analysis. It is a tool to analyze how the different values of a set of independent variables affect a specific dependent variable under certain specific conditions. A sensitivity analysis can be used in a wide range of fields, including biology, geography, engineering, and economics. It is particularly useful when analyzing a black box process. This is when several inputs result in an output that can't be studied or analyzed. The output is also known as the output opaque function. A sensitivity analysis positions the analyst to focus on the critical drivers, therefore saving time and resources by avoiding the drivers that have little impact on the results. So what are the qualitative steps involved? When beginning sensitivity analysis, you must first identify both the input and output variables. These input variables can be hard, verifiable data or rough estimates. Next, if the data isn't already quantified, add credible numbers to each input variable to determine the input baseline. You want to set maximum and minimum values for each variable, and how accurate these estimates need to be will vary, as it may make no difference or any change may have a major impact on the outcome. Sensitivity analysis will help the analyst determine how important each assumption or estimation is. Now that we have our variables, let's move on to the quantitative steps. So first, you must calculate the baseline values of the output variable using the previously determined baseline input variables. Second, adjust the volume of one input variable while leaving the others constant and calculate the new output variable value. Third, calculate the percent change of both the input and output variables compared to their baseline values. Fourth, calculate the sensitivity of the output based on the change of the input. To get the sensitivity, you take the percent change in output and divide it by the percent change in input. You then repeat steps 2 through 4 for each input variable. So let's look at an example. Say a firm is looking at a project with an initial cost of $10,000 and a useful life of 2 years. They decided to have the sales price and fixed cost be the input, or the drivers, and the net present value be the output. Now that we have the variables, we need to determine the base. For year 1, sales equal $15,000, the fixed cost of $1,000, variable cost is $5,000, and the discount net cash flow, or DNCF, equaled $7,379. For year 2, sales is $18,000, fixed cost $1,200, variable cost $6,000, and a DNCF of $8,848. To get the baseline NPV, we take the initial cost of the project, $10,000, and add the DNCF of each year. So year 1 was $7,379, and the DNCF of year 2 was $8,838. That equaled $6,217. Now for simplicity, depreciation expense was $100, earnings before tax, tax expense of 6% of EBT, net income, and net cash flow aren't shown. DNCF is rounded to the nearest dollar, and all percentages and sensitivities are rounded to the second decimal point. The first variable we'll look at is sales. Assuming the sales price will be 5% higher than baseline value, and all of the inputs remain constant, this results in a DNCF of $7,987 in year 1 and $9,567 in year 2. We use the same method of getting the baseline NPV, initial cost of the project, plus the DNCF of each year to get the S variable NPV of $7,554. To get the percent change in S variable NPV, you take the S variable NPV of $7,544 and subtract the base NPV of $6,217. You then divide that by the base NPV and that equals 21.51%. We then calculate the sensitivity by taking that percent change in NPV of 21.51 and divide it by the input percent change of 5% to get 4.3. This means that an increase or decrease of sales by 1% will result in a 4.3% increase or decrease change in the NPV, respectively. Next, we'll look at the fixed cost variable. Assuming a 5% increase from the baseline value and all other inputs remain constant, this results in a DNCF of $7,339 in year 1 and $8,789 in year 2. Following the same process of the first variable, we get a variable NPV of $6,178 and a percent change in NPV of negative 0.63%, a sensitivity of negative 0.13. This means that an increase in fixed costs of 1% will have a result in a 0.13 decrease in NPV and vice versa. So through this process, we can see that the sales price should be estimated as accurate as possible since it has a larger sensitivity than the fixed cost. Thank you.